What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we're going to be covering the basics of the wheel strategy and options trading with my Robinhood portfolio. So if you're excited for today's video or just want to learn more about how options works, feel free to like the video, subscribe to the channel if you've not already done so, and turn on your bell notifications for all future uploads. As per usual, the support of the channel has been absolutely awesome, so thank you so much, and the more support you give, the more awesome content I can give you guys. So we're going to be covering what is called the wheel strategy, which is an options trading strategy that you can use to collect passive income. Now, the idea behind it is not one of those crazy complex strategies. It is a more simplistic one, but it makes sense, and you'll be able to see how you can apply it maybe to your portfolio. But again, this is not financial advice. I am not a financial advisor. This is what I am doing in my portfolio. So I'm going to explain how this essentially is going to work. So I will give you an example in the portfolio that we have right here, sitting at $61,500. Has not really gone up much because I have I'm putting money into my Roth IRA. So I've kind of stopped with this one and started putting money into my Roth, so that way I get tax advantages and everything else. Why I didn't do it earlier, I honestly have no idea. So what we're looking at here is, I can give you an example, which is on NVIDIA. So the stock ticker NVDA, as you already know, if you're an option or if you're an investor in general, is NVIDIA here. And basically how this wheel strategy works is you are first going to be selling what is called a cash secured put, or a CSP. What that basically means is, instead of being the one that's buying the options and hoping that it goes in your direction, you are going to be the seller instead. Now, the reason why I like doing this is because imagine this idea of options kind of like the casino, where the hope behind it is that you make it big, but in the long term the house is who makes the money, because the edge is more on the house. So I like to put myself in basically what the house's side is in terms of options trading, because a lot of options that you look at, a majority of them do not work out and they end up expiring worthless. Now, what we're going to look at here is, I'll give you an example, and you can see I do have an NVIDIA put right here. And what my logic is to hopefully generate about 1 to 1.5% on this stock every single week. Not on the whole portfolio, but just on the trade by itself. So essentially how it is going to work is, we're going to first show you how a cash secured put works. So what you're going to do is, you can go over here, it'll say trade NVIDIA options. You click it right over here. And as you'll see, you have buy and sell, and you have call, and you have put. Now, again, the buyer side is what people more like to do. If you think about the GameStop saga and the AMC, people are buying up calls and everything else and hoping that goes higher. So basically what happens here is, you have a buyer and you have a seller, and you have calls and you have puts. Now, how the call and put works: call basically means you're hoping the stock goes up. Put means you're basically hoping the stock is going to go down. Okay, so you can buy a put. So for example, if I want to buy the $119 strike price for the put, it would cost me $320. Basically what that means is that I'm going to hope that NVIDIA is going to be below $119. But what you will see says break even is $115. That's because you got to factor in how much you're paying for it, because you're paying $320. Before you say, well, Fridge, it says $3.20. Again, an options contract gives you access to 100 shares of the stock without buying 100 shares. So 100 shares of NVIDIA is $11,800. You can have access to 100 shares for a limited time for $320. Now, the reason why I say limited time is because what you have up top is what's called expiration dates. Basically means that this is a contract between the buyer and the seller, and you want to hope that something plays out in your favor. And you have until, for example, February 7th, which is 3 days out at the time of recording this video. So what you basically have here, again, is the options contracts have 100 shares worth of whatever the stock is. You have expiration dates for it, you have break evens, and you have prices you have to pay. Now, again, any price you pay, you multiply by 100, because this is the price you pay for one share, and the contract is worth 100 shares. That's where they get the $320 max loss if this expires worthless. So essentially what is going to be happening here is, you are going to be hoping that NVIDIA will go down if you buy a put. Now, if you sell a put, you're hoping the opposite. So if the buyer of the put wants it to go down, the seller of the put would want it to go up. And vice versa. If you wanted to buy a call, you would hope it goes up. If you sell a call, you hope that it goes down, right? So it's kind of like inverse in that aspect of the buyer versus the seller. So what I would do here, and I'll walk you through what my strategy is right now. So what I have right now, as you will see, let's go back to my Robinhood portfolio here first. So as you will see, we have a cash secured put here, It has $11,100 in cash collateral. That's why it's cash secured, because if this option does go into the money, you are forced to buy the shares at the strike price. That's one thing to make a note of. If Nvidia goes down to $111 and under by February 7th, I will be forced to buy 100 shares at this strike price right here, which is why that's the cash collateral. $100 or 100 shares times $111 gives me the collateral here. Now, what you'll notice is that I have a $111 put that I sold. Again, as you'll see, it says it sold it. I didn't buy it. I sold it. Now, what this basically means is that I'm hoping Nvidia does not go down to $111 by Friday. So what you'll see is you'll go over here, sell put. And I'm basically just hoping that it doesn't go down below $111. And right now it's sitting at a pretty good profitability chance of it happening and expiring worthless. As long as Nvidia stays above $111, it could be $111.05 for all I care. As long as it stays above $111, then this contract expires worthless and I keep the premium. Now, what that basically means is, again, the buyer will be paying $66 for this contract, which means that the seller, which is me, would get $66. Now, for my option, I think I got it at like $150. So what you will notice with this option here is that this option is already up $100 or up $87. So I originally opened it up and I believe I got it for $153. So I sold this option at the end of last week and for $153. So that's premium that I get paid out up front. So I'm getting paid $153. And as long as Nvidia doesn't go down to 111, I'm chilling. I'm good. I keep $153 and then I move on to the next week and I move on to the next week and I keep going and going and going. Now, as you will see right now, as time goes on, this is called decay. As time has gone on in this, the stock has not gone down. It got pretty close at $112.50, but then it rebounded back up. And right now it's sitting at about $119. So as long as the video doesn't go to 111, then I'm good to go. So I'm kind of just watching it, managing it, making sure there's no crazy sell-off that happens as this goes. But right now I'm looking at making $153 on this share, on this contract that I have right now. Now, some people have been asking me either on After Hours, on Discord, on YouTube, Instagram, whatever, about how I look at this and what I'm doing. So what I did was I sold a option, and what I did when I sold this option here was I look at the delta value. Delta basically means it's the probability of making profit. So right now it's sitting at about a 15% chance of it being profitable, which means that's very, very unlikely to happen. I look for like a 20 to a 30. 30 is a little bit more risky. I look for like a 20, 25% delta in this case. So it's out of the money. It's unlikely to happen, but if it does happen, then we can always manage the position from there. So for example, if you look at like the 114, for example, the 114 gives you a 26% delta. So 26% of the time, this is going to be in the money, but 74% it will not. Again, it creates that house's edge in your options portfolio, and that's what I'm looking to do. So that's kind of the idea of how the cash secured put works. So again, for me personally, I sold mine and it cost me $11,000 in collateral. Again, it's not my actual, I didn't pay that much for it. That's how much is on the sideline in case I get exercise on this position here. But if it's $11,000, I made $153. You're looking at over 1% return in the week. I've been doing this week in, week out. I'm starting to do it recently with Nvidia. So it started coming down a lot. It's been in my price range basically to look at. So as you'll see here, I sold one on the 31st. Or on the 29th, I bought it back on the 30th because I basically collected most of my premium back. So they paid me $61 to open it. I paid $8 to close it. So I made $53 in this trade here. And now I'm looking at $153 again for this week. So I'll be up almost $200 in 2 weeks. And that's just me just using cash to be able to pay for this. And again, you don't have to actually use this cash. It's a cash secured put because that cash is put on hold until you get exercised if you want to. So a couple things to note when I'm selling cash secured puts in this kind of portfolio is to do it on stocks you don't mind owning. So for me personally, if I get exercised on Nvidia, oh no, I have 100 shares of Nvidia. Oh no, woe is me. What's the big deal? That's not a big deal for me. Okay, I'm sure everyone would love to have 100 shares of NVIDIA stock, right? So having it at 100 shares at a lower strike price means that I got it for a discount. I'm buying it for a bargain. Imagine buying 100 shirts for a cheaper price compared to paying full retail for it. That's what a cash secured put does. So companies like NVIDIA, maybe Apple, maybe Meta, maybe Google, for example, like those are ones, if you want to own them, this is a good way to either reduce your cost basis or to even open a position initially. So I like that I'm at this stage right now. And again, if I don't have to buy the shares, I just keep the $150 and I move on to the next week and I do it again, and I do it again, and I do it again, week to week to week to week to week. So let's say that, again, if I wanted to go a little bit farther out, say I want to go out into next week, so the 14th, Valentine's Day, woo! So say I want to look at a cash secure put, I'm going to bet that NVIDIA maybe won't go under 108. That's a very low delta, so it's actually really, really good. So again, 16% of the time it'll be profitable, 84% it won't. But I'm looking at a 1% return here. $108 for $108. So you're looking at a 1% return here in just a little bit over a week, which you think, well, Fridge, that's not a lot of money. But again, 1% a week for 52 weeks in a year, you're making 50% on, say, $11,000 or $10,000. You're making $5,000. And that's not even my major portfolio amount. My major portfolio is over 60,000 right now. So you can really scale this up and really get some extra income coming in just for that. Imagine getting paid $100 a week, basically to make sure that the strike price doesn't go below, right? That's all you're going to do. If you want to go a little bit more risky, maybe go $110. Delta is 20% there. So a little bit higher up, but a little bit more of a return here, a little bit over 1% you're looking at, which is totally cool. So that's things I like to look for first. I don't like to go right to the strike price because, as you'll see, a lot of payout here, but you have a very high chance of it being exercised, almost 50% chance of this happening. That's basically a gamble. So you pick the ones that are a little bit farther away, so that way it gives you a little bit of chance to have time be on your side as each day goes by. The stock doesn't get close to your strike price. You keep collecting that premium. That money keeps going. That contract starts to lower in value, means you get more of the premium, and then it closes, it expires worthless, and then you're good to go. Ideally, you want it to expire worthless, but for right now, obviously it's not, because I still have, at the time of recording this, I still have 3 days left in the stock market for NVIDIA to crash, which is a possibility, but I'm not looking for it to happen. So that's kind of the idea we're looking at right now. It looks like NVIDIA is pumping up right now because AMD, I think, just had really killer earnings. So this will be worth even less, which will be great. I wonder if I can show the simulation of this. I don't think I can on Robinhood. Oh, maybe I can actually. I know how to do it. So let's take a look here. NVIDIA, is there a way to simulate earnings? Yes, there we go. So if I want to simulate this, so right now it's sitting at $99. Now it's sitting at $99 already, which is amazing. And as time goes on, the contract becomes worthless and worthless and worthless. So I'm going to wake up tomorrow morning, market opens at 9:30, and it's going to be worth $120 already. It was now originally at $100. Now it's at $120. So I keep getting more of those returns as the stock doesn't hit the strike price. So it's a really cool thing to see. I like it. It's very passive income, makes my life be a lot easier. Now, there are two things you can do, and people will say, well, Fridge, what happens if it goes in the money? Which is a possibility. I have been assigned shares before. Happened with Tesla like a little over a year ago. Don't ask me about it. But the idea behind it is saying, what are the options you can do? And there's essentially two options. First option is you let NVIDIA be at 111, you buy the shares, the cash goes to you, cash gets spent, and then you now own 100 shares of NVIDIA. That's the first thing you could do. The second thing you could do is you could roll the position if you really don't feel like owning it now and you want to own it a little bit later on. So what does that mean? So right now, here's my contract, $111 by the end of this week, and we're good. But let's say it was at 111 right now, and I was in the money. Basically, like I was going to be at risk of being assigned shares. I can do what's called roll the position, which is right over here. I can hit roll the position here and say I want to roll it out one extra week. My strike price is for the 7th. Say I want to roll it out to the 14th, so add myself an extra week. I can roll it out an extra week, and I can still keep the same strike price, as you'll see. I can still keep the same strike price, but push it out another week. And believe it or not, with how this idea works, since you're adding extra time, your stock could obviously go down, but your stock could rebound. And you actually can get an additional $102 if you roll it out another week. I could roll this out to this strike price of 105. So I've reduced my cost to $6 per share, which is $600 because it did $100 share increments. And I also get a whopping $1, basically break even for at this point. So I can basically reduce my cost basis by $6 per share. And if it keeps dropping further, I can just keep rolling it and rolling it and rolling it until I'm like, you know what? I'm ready to go. I'm ready to exercise, buy those shares, pump it back up, hopefully, and hope for the best. So you can roll your position out lower if you need more time to be on your side. I will give you an example. I do it with SPY, but with covered calls, which is a different scenario. But essentially what's going to be happening is covered calls is the inverse of cash secured puts. Once I own 100 shares of SPY, which I do is my main portfolio, I can then sell a cover call saying, hey, I don't want SPY to go to $609. And right now it's at 600, right? So this example is a cover call. You need to have 100 shares of your position, of your shares in order to sell a covered call because it's covered by the amount of shares that you own. So this one right here is going to be expiring next week on the 14th. And I sold it for $712, again, times 100. And the reason why this is so much higher is because obviously the strike price is $600 compared to $100 for NVIDIA. And so what you're looking at here is saying, hey, Fridge, as long as it doesn't go to $609, then I keep my shares that I own and I collect the premium as well. So which is good. If it goes above $609, I sell it at $609. But again, what you will notice is I rolled my position because what happened in this case was an example of, I rolled it last week, the 23rd. So actually almost 2 weeks ago now. I rolled it from 601 to 609 because the market had a huge rally and I was in the money and I didn't want that. So I rolled it out further. And believe it or not, I got paid an extra $38 to roll the contract out even farther. So I got paid extra. I pushed the strike price up $800 basically, because again, $8 times 100. I pushed it up $800 so that way I get higher returns if my stock ends up being sold. And I also got paid a little bit more for it. And so I've been doing the same thing. I'm rolling positions. The reason why I'm rolling the position, and if you're at this point in the video and it's been long, I apologize, but thank you for following so much. As I roll the position, the reason why I am rolling my position is because since SPY is a major position, almost all my portfolio, I believe, is 96.67% or whatever it is. I've made $6,000 on SPY. If I have to sell my shares, these gains get realized, and then your boy has to pay taxes on that. So what I'm doing is if I keep rolling my shares out further and further and further, the gains go up. But as long as I don't have to sell my shares, I don't realize these gains. I don't get taxed on it. So that's just an advice that I'm looking at doing, and not financial advice, of course. But my logic behind it is to sell cash secured puts. Then once I get assigned the shares, I then sell covered calls. If I get assigned covered calls, and then that happens, I take that cash and I go back to puts. So it's called the wheel strategy because you rotate over and over again. Cash secured puts gives you 100 shares of a stock at a discount. Selling covered calls, then if it hit the strike price, you sell off your shares. Then use that cash to do cash secured puts again. Then cover calls, puts, calls, back and forth. It's the wheel strategy that you're doing over and over and over again. So thank you so much for watching today's video. If you made this fun in the video, feel free to like, subscribe to the channel, and turn on the bell notifications for all future uploads. I hope you guys are making money in the market, as am I, and I will see you guys in the next video.